What if the biggest threat to your financial future isn't a market crash, a recession, or even inflation, but your own sense of comfort? What if the real danger appears not when everyone is afraid, but when everyone feels safe? History doesn't announce its turning points with sirens. It whispers them through confidence, through headlines about record highs, through reassuring experts telling you that this time is different. And by the time most people realize something fundamental has shifted, the transfer has already happened. The prepared quietly gain power. The unprepared quietly lose it. Section 1. The illusion of stability. There is a strange pattern that repeats itself throughout financial history. Just before major economic disruptions, the majority of people feel calm. Not ecstatic, not panicked, just calm. Markets may be slightly volatile, but nothing seems broken. Jobs still exist, banks are still open, portfolios still show numbers on a screen. Life appears to move forward normally. And that normality becomes the most dangerous illusion of all. Think about 2007. If you walked through any American suburb that summer, you would have seen freshly cut lawns, new SUVs in driveways, for sale signs proudly advertising rising home values. Dinner conversations revolved around remodeling kitchens or buying second properties. Mortgage brokers were treated like trusted advisors. Home equity felt like a permanent ATM. The word risk barely entered casual conversation. If someone had warned that within 18 months, trillions of dollars in wealth would evaporate, they would have been dismissed as dramatic, maybe even paranoid. Yet by late 2008, retirement accounts were cut in half, banks collapsed, and decades of savings disappeared in what felt like weeks. Why does this happen? Why do the most painful economic transitions always seem to catch people off guard? Is it ignorance? Is it arrogance? Or is it something deeper? Something psychological? Human beings are wired to assume that the recent past will resemble the near future. If the market has gone up for years, we begin to believe that upward movement is natural, almost inevitable. If home prices have only risen in our adult lives, we struggle to imagine them falling sharply. Stability conditions the mind. It creates a story of continuity. And that story becomes more powerful than data, more powerful than warnings, more powerful than logic. Consider the late 1920s. In 1928 and early 1929, newspapers celebrated technological progress and industrial growth. Radio was transforming communication. Automobiles were becoming mainstream. The stock market seemed like a symbol of modern prosperity. Ordinary citizens opened brokerage accounts for the first time. Leverage became common. Buying stocks on margin felt sophisticated. The belief was simple. America had entered a new era of permanent expansion. Then, almost without warning, the market collapsed. Fortunes built over decades were erased. The illusion of permanent prosperity dissolved in months. But here is the part most people miss. The signs were visible. Credit had expanded rapidly. Speculation had replaced investment. Asset prices were detached from underlying earnings. Yet the majority ignored these signals because the emotional environment felt stable. Comfort is seductive. It tells you not to question what appears to be working. Fast forward to the early 2000s. The dot-com boom created a similar environment. Young companies with no profits achieved billion-dollar valuations. Taxi drivers and college students discussed IPOs. Traditional valuation metrics were dismissed as outdated. The narrative was powerful. The internet had changed everything. Old rules no longer applied. And in some ways, technology truly was transformative. But price still mattered. Cash flow still mattered. Reality still mattered. When the bubble burst, trillions vanished. Many companies disappeared entirely. So let me ask you something difficult.
If we were in a similar late-stage environment today, would you recognize it? Or would you interpret warning signs as temporary noise? Would you question valuations, debt levels, and monetary policy? Or would you trust that experts have everything under control? The illusion of stability is reinforced by institutions. Central banks intervene during downturns. Governments implement stimulus programs. Markets recover faster than expected. Each rescue strengthens the belief that collapse is unlikely. We begin to assume that someone will always step in, that safety nets are permanent, that volatility is manageable. Over time, this breeds complacency. But cycles do not disappear simply because tools become more sophisticated. Debt does not become harmless simply because interest rates are low. Risk does not vanish simply because financial engineering becomes complex. If anything, complexity can hide fragility. When systems become interconnected, stress in one area can spread rapidly to another. What looks stable on the surface can be deeply vulnerable underneath. There is also a social component to stability. If everyone around you appears confident, it becomes harder to feel cautious. If your neighbor's portfolio is growing and your colleagues are discussing investment gains, doubt feels irrational. Human beings are social creatures. We calibrate our beliefs based on group behavior. When optimism becomes widespread, skepticism feels isolating, and so most people conform. This conformity is not stupidity, it is survival instinct. For most of human history, aligning with the group increased chances of survival. But in financial markets, group alignment can amplify risk. When everyone buys at the same time, prices detach from fundamentals. When everyone sells at the same time, panic accelerates losses. Stability can quickly transform into instability, not because reality changes overnight, but because perception does. Think about housing before 2008. Banks issued mortgages to borrowers with minimal documentation. Complex financial products packaged these loans into securities rated as safe. Investors around the world purchased them, trusting the ratings and the models. The system functioned smoothly, until it didn't. When defaults began rising, confidence cracked. Once confidence cracked, liquidity disappeared. And once liquidity disappeared, prices collapsed. The structure had been fragile long before it failed. The failure simply revealed what was already there. The lesson is not that collapse is inevitable tomorrow. The lesson is that stability should never be mistaken for permanence. Stability is often a phase within a larger cycle. It is the quiet middle before transition, and the longer stability persists, the more extreme the eventual adjustment can become. So how do you protect yourself from the illusion? The first step is intellectual humility. Recognize that markets are cyclical. Recognize that human behavior oscillates between fear and greed. Recognize that debt expansion cannot accelerate indefinitely. Ask yourself uncomfortable questions. What assumptions am I making about the future? What would have to be true for those assumptions to fail? If asset prices declined by 50%, would my life plans collapse, or would I remain flexible? Another step is historical awareness. When you study past cycles deeply, not just headlines but underlying conditions, you begin to notice patterns. Rapid credit growth, asset bubbles, excessive leverage, policy responses that postpone correction but increase long-term imbalances. These patterns do not guarantee immediate crisis, but they signal vulnerability. And vulnerability matters more than headlines. Markets often appear strongest just before they weaken. Optimism often peaks before reality intrudes. If you wait for visible panic before adjusting, you are already late. By the time news becomes universally negative, much of the damage is done. Consider the emotional experience of someone approaching retirement in 2007. Their portfolio might have shown steady growth for years. Confidence was high. Then, within 18 months, half of it vanished. Even if markets eventually recovered, time did not. A 35-year-old can wait for recovery. A 60-year-old cannot easily rebuild lost decades of compounding. Stability, in hindsight, had masked fragility. This brings us to a deeper question. What is stability really? Is it rising asset prices? Is it low volatility? Or is it resilience, the ability to withstand shocks without permanent damage? True stability is not the absence of turbulence. It is the presence of preparation. It is the design of a structure that can endure stress. Most people define stability emotionally. If markets feel calm, they feel stable. But emotional calm can coexist with structural imbalance.
Here is what almost nobody talks about when markets are calm and headlines are reassuring. Beneath the daily noise of earnings reports, interest rate debates, and election cycles, there is a much larger rhythm unfolding, one that spans generations, not quarters. Debt cycles of this magnitude do not operate on the timeline of news anchors or social media trends. They unfold over 75 to 100 years, slowly building pressure beneath the surface of normal life. The last time the world experienced the end of a long-term debt supercycle was in the 1930s and 1940s, and when it ended, it did not fade quietly into history. It exploded into the Great Depression, global defaults, currency devaluations, and eventually World War. Why does this matter to you now? Because when these cycles end, they don't simply cause recessions, they trigger massive transfers of wealth from those holding the wrong assets to those positioned in the right ones. And the transfer does not happen because some people are smarter. It happens because some people understand the cycle while others assume the present will continue indefinitely. Think about how debt works at a personal level. When you're young, you borrow to accelerate growth. You take a mortgage to buy a home. You finance education to increase future earning power. Borrowing makes sense when income is rising faster than obligations. Now imagine that behavior scaled to corporations and then to governments. Over decades, borrowing increases because it fuels expansion. Credit becomes easier, interest rates decline, asset prices rise. Rising asset prices make people feel wealthier, which encourages more borrowing. That borrowing pushes asset prices even higher. It feels virtuous, productive, and even sophisticated. But here's the question. What happens when debt grows faster than the income required to service it? What happens when the entire system depends on permanently low interest rates to remain stable? The long-term debt cycle is essentially a story of compounding leverage. In the early stages, debt supports productivity. In the middle stages, debt inflates asset values. In the late stages, debt becomes the primary engine holding growth together. And eventually, it reaches a point where new borrowing no longer creates real economic expansion. It merely sustains existing obligations. At that moment, the system becomes fragile, not visibly broken, but structurally strained. You can think of it like a bridge carrying heavier and heavier loads each year. From a distance, it looks fine. Cars cross it daily. Traffic flows smoothly. But internally, stress fractures are forming. The bridge does not collapse because of one extra vehicle. It collapses because decades of incremental pressure finally exceed tolerance. Look back at history. In the late 1920s, credit expansion had reached unprecedented levels. Investors borrowed heavily to buy stocks. Banks were deeply intertwined with speculative markets. When confidence cracked, leverage amplified losses. The Great Depression was not merely a stock market crash. It was the violent unwinding of excessive debt accumulated over years. In the 1970s, the crisis manifested differently. Rather than deflation and defaults alone, governments turned to inflation to manage debt burdens, eroding purchasing power dramatically. In 2008, the trigger was housing and complex financial instruments built upon layers of borrowed money. Each crisis had different surface details,
But the underlying pattern was the same: long-term debt expansion followed by painful adjustment. Now consider the present. Total debt levels relative to GDP are historically extreme. Government debt, corporate debt, consumer debt, all elevated. Interest payments consume growing portions of national budgets. Central banks have intervened repeatedly over the past 2 decades to prevent deep recessions, lowering rates and expanding balance sheets. Each intervention stabilized the system temporarily, but each one also increased dependency on low borrowing costs. Ask yourself, can debt expand faster than economic output forever? Can interest rates remain suppressed indefinitely without consequences? What happens if inflation resurfaces persistently, or if growth slows while obligations remain fixed? Here's the unsettling part. Long-term debt cycles are invisible to most people because they unfold gradually. A 5-year chart rarely reveals them. Even a 10-year chart can obscure them. They require generational perspective. And because they're rare, institutional memory fades. The generation that personally experienced the Great Depression is no longer leading financial institutions. The emotional scars of that era have faded into textbooks. Without lived memory, complacency grows. Policymakers assume they can manage risks with modern tools. Investors assume diversification across traditional assets is sufficient. But cycles are indifferent to confidence. They respond to arithmetic. When these cycles approach their end, they do not announce themselves with a clear calendar date. Instead, they present a series of warning signals: elevated leverage, narrowing policy options, rising interest burdens, and increasing political tension around economic inequality. The adjustment can take many forms: deflationary collapse, currency devaluation, restructuring of obligations, or persistent inflation. But in every historical case, wealth shifts dramatically. Those heavily exposed to overvalued paper assets often suffer permanent losses. Those holding assets that preserve real purchasing power often emerge stronger. So let me ask you something that may feel uncomfortable. If we are indeed in the later stages of such a cycle, where are you positioned? Are your assumptions based on the last decade of market performance or on a century of cyclical history? Do you believe central banks can indefinitely engineer soft landings, or do you acknowledge that constraints eventually tighten? If a structural reset were to unfold over the next decade, would your portfolio benefit from it or be damaged by it? The critical insight about long-term debt cycles is that they do not punish everyone equally. They redistribute. During the 1930s, those holding gold preserved purchasing power, while many stock investors were devastated. During the 1970s, holders of real assets, such as energy and commodities, outperformed while bondholders suffered severe real losses. During 2008, highly leveraged homeowners lost properties, while those with liquidity acquired assets at distressed prices. The pattern is consistent. Periods of excess reward those who prepare and penalize those who assume continuity. And yet, most people ignore the possibility of generational shifts because they're psychologically uncomfortable. It's easier to believe that economic management has improved permanently. It's easier to trust that growth will outpace debt. It's easier to remain aligned with consensus. But cycles don't disappear because they're inconvenient. They conclude when imbalances can no longer be sustained. This is not a prediction of imminent catastrophe. It is a recognition of structural mathematics. Debt compounds. Interest compounds. Eventually, the capacity to service that compounding must match it. When it does not, adjustment follows. The form of adjustment can vary, but the reality of adjustment does not. If you zoom out far enough, the pattern becomes almost mechanical. Expansion, leverage, confidence, excess, constraint, renewal. Each stage feels permanent while it is happening. Each stage feels unprecedented, yet history shows repetition beneath variation. The names change, the technologies change, the financial instruments evolve, but human behavior and arithmetic remain constant. So perhaps the most important question is this: are you studying the surface or are you studying the cycle? Are you reacting to daily volatility or are you positioning for structural transition? If a long-term debt cycle is indeed nearing its conclusion, the window for gradual repositioning is far more valuable than reactive panic later, because once adjustment accelerates, flexibility shrinks. The cycle most people don't see is not hidden by secrecy, it is hidden by scale. It is too slow for headlines and too large for quarterly thinking. But those who recognize it gain something rare: perspective. And perspective is often the difference between being surprised by history and being prepared for it. In 2006, I met a man named Richard, and if you had met him back then, you would have described him as the model of financial responsibility. He was 54 years old, a senior engineer who had spent 3 decades doing everything society tells you to do if you want security. He avoided lifestyle inflation, drove sensible cars, paid off his mortgage early, and contributed diligently to his retirement accounts. He and his wife skipped extravagant vacations for years so they could invest more. By the time we spoke, he had accumulated $1.8 million, an amount that represented not luck, not inheritance, but discipline. He worked with a well-known wealth management firm, paid nearly $20,000 a year in advisory fees, and followed what was considered textbook diversification: 60% equities for growth, 40% bonds for stability. He wasn't speculating on tech startups or chasing exotic derivatives. He was following the rules. So let me ask you something. If someone like Richard could lose half of what he built in less than 2 years, what does that say about the rules themselves? When we first sat down, I told him something that made him visibly uncomfortable. I explained that we were late in a long-term debt cycle, that housing prices were inflated beyond sustainable income growth, that banks were deeply exposed to complex securities few truly understood, and that the apparent calm in markets masked structural fragility. He listened politely but skeptically. His advisor had already reassured him. They showed him charts stretching back decades demonstrating that markets always recover over time. They explained that temporary downturns were normal and that diversification across stocks and bonds historically provided resilience. They told him staying invested was the rational choice. And here's the part that matters. The data they showed him wasn't false. Over long periods, markets had indeed trended upward. Bonds had historically buffered volatility. The advice sounded logical. So Richard asked himself a simple question: who should I trust? The cautious outsider warning of systemic risk, or the credentialed firm managing billions of dollars? What would you have done in his position? In 2007, the market continued climbing. Richard's portfolio grew from $1.8 million to $2.1 million. He felt vindicated. He began to think the warnings had been exaggerated. After all, everything looked stable. Unemployment was low. Credit was flowing. Real estate in his neighborhood was still rising. He and his wife began planning seriously for early retirement. She circled listings for a small vacation home in Florida. They talked about spending winters by the ocean. They even booked a Mediterranean cruise for the following year, a celebration of decades of sacrifice finally paying off. From the outside, it appeared that discipline had triumphed. But here's the question no one asked at the time. What happens when the system itself is fragile, even if your personal behavior is sound? Then 2008 arrived. At first, it felt like a correction, just another dip in a long bull market. Advisors repeated familiar language: stay the course, don't panic, markets recover. But as months passed, the losses deepened. Banks failed. Headlines turned ominous. The value of Richard's portfolio began falling faster than he had ever experienced. Within 18 months, that $2.1 million had shrunk to $970,000, a 54% decline. Decades of disciplined saving had been cut nearly in half. Imagine watching numbers on a screen erase years of work. Imagine explaining to your spouse that the retirement timeline may need to change. Imagine lying awake at night calculating whether the remaining balance could sustain 2 lives for potentially 30 years. What would that do to your confidence? Richard's advisor remained calm. They emphasized that markets had always recovered historically. They showed updated projections assuming eventual rebound. But here's the problem. Recovery requires time, and time is a resource unevenly distributed. A 30-year-old investor can wait a decade for markets to rebound. A 56-year-old nearing retirement cannot easily reclaim lost compounding years. By the time markets fully recovered around 2013, Richard was 61. His retirement projections showed he was now more than $800,000 short of his target. He postponed retirement from 60 to 65, then to 67, eventually to 70. Today, at 72, he still works, not because he loves engineering, but because the financial margin he once relied upon vanished during a period he was told would be temporary. And here is the most painful truth. Richard was not reckless. He was not chasing speculative bubbles. He did not ignore advice. He followed mainstream financial guidance precisely. The system did not fail because he was irresponsible. It failed because conventional models assumed stability during a period of structural fragility. The 60-40 portfolio, long considered a cornerstone of prudent investing, proved vulnerable when both equities and certain fixed income assets declined simultaneously under systemic stress. Diversification across correlated paper assets offered less protection than historical averages suggested. So the question becomes deeper. Is diversification enough if the assets you are diversified across are exposed to the same underlying risk? There's another dimension rarely discussed, the psychological toll. During the downturn, Richard's sleep deteriorated. He checked his accounts compulsively. He second-guessed every financial decision of the past decade. His wife tried to remain optimistic, but uncertainty strained their conversations. Stress affects health. It affects relationships. It alters perspective. Financial loss is not purely mathematical. It is emotional. And when advisors say, stay the course, they often underestimate the psychological cost of watching life savings evaporate. Would you have held steady if half your retirement disappeared? Or would fear have pushed you to sell near the bottom, locking in losses permanently? Meanwhile, the advisor who recommended staying fully invested continued collecting fees. That is not an accusation of malice. It is a structural reality. Most advisory models are built on asset management. They benefit when capital remains deployed within their framework. They are not typically incentivized to recommend large allocations to assets outside traditional portfolios. So when systemic risk rises, their default advice remains consistent. Remain diversified, remain patient. But patience in the wrong environment can be expensive. The tragedy of Richard's story is not merely that he lost money. Markets eventually recover. The tragedy is that timing and life stage transformed a cyclical downturn into a permanent lifestyle shift. The Florida home never materialized. The Mediterranean cruise was canceled. His golden years became extended working years, and he did everything society told him would guarantee security. So here's the uncomfortable question. If doing everything right under conventional guidance still leaves you vulnerable to systemic cycles, what adjustments might be necessary? Richard's experience illustrates a critical principle. Conventional advice works best during conventional times, but late-stage debt cycles are not conventional. They compress volatility, inflate valuations, and then release pressure abruptly. Standard asset allocation models are often calibrated using historical averages that assume normal distribution of risk. But crisis periods are not normal. Correlations shift, liquidity evaporates, assumptions break down. The very safety mechanisms investors rely upon can fail simultaneously. This does not mean abandoning markets or living in perpetual fear. It means recognizing context. It means asking whether the macroeconomic environment resembles the stable decades used to design traditional portfolios, or whether it resembles late-stage conditions where leverage is elevated and policy flexibility is limited. It means acknowledging that risk is not static, it evolves with structural imbalances. If you were sitting where Richard once was, comfortable, diversified, reassured by charts showing long-term recovery, would you question the foundation? Would you consider reducing exposure before volatility arrives, or would you wait for visible cracks, at which point repositioning becomes reactive rather than strategic? Richard's story is not unique. Thousands of disciplined savers experienced similar outcomes during 2008. Many recovered eventually. Some did not. The difference often lay not in intelligence or work ethic, but in timing and positioning relative to systemic risk. And that is the quiet lesson beneath the narrative. Markets reward discipline, but they also reward awareness of cycle stage. Without awareness, discipline alone may not protect you. So the real question is not whether markets will rise again. They almost always do over long horizons. The question is whether your horizon aligns with the time required for recovery. The question is whether your portfolio is structured to withstand severe drawdowns without altering your life trajectory. And the most important question of all, are you relying solely on conventional wisdom, or are you willing to examine whether the current environment demands unconventional preparation?
The economy is not a chaotic storm of random events, even though it often feels that way when headlines scream about recessions, rallies, crises, and recoveries. It is a machine, and like any machine, it runs on identifiable forces that interact in predictable rhythms over time, even if the timing is never perfectly precise. At its core, the economic machine is driven by three forces: productivity growth, short-term debt cycles, and long-term debt cycles. And understanding how these three layers interact is the difference between reacting emotionally to news and anticipating structural shifts before they fully unfold. Productivity growth is the simplest layer to grasp. It answers a basic question: are we producing more value per person this year than we did last year? When innovation improves efficiency, when technology allows workers to produce more output with the same effort, living standards rise sustainably. Over long stretches of history, productivity is what makes societies wealthier. It is the reason we live longer, travel faster, and communicate instantly across continents. But productivity alone does not explain booms and busts, because even when productivity grows steadily, economies still expand and contract. Why? Because debt amplifies everything. Short-term debt cycles operate over roughly 5 to 8 years. They're the reason recessions appear every 7 to 10 years with almost mechanical regularity. The pattern begins innocently. Credit becomes available, interest rates are relatively low, businesses borrow to expand, consumers borrow to spend, asset prices rise, optimism grows. As spending increases, incomes rise, reinforcing confidence. But eventually, the economy overheats. Inflation begins creeping upward. Central banks respond by raising interest rates. Borrowing becomes more expensive. Consumers slow spending. Businesses delay expansion. Asset prices soften. The economy contracts. Policymakers then lower rates again to stimulate borrowing, and the cycle repeats. If this were the only cycle operating, downturns would be manageable resets, temporary contractions followed by renewed growth. But beneath these short waves lies a deeper, slower force that most people never notice until it's too late. The long-term debt cycle unfolds over decades. Unlike the short-term cycle, it does not fully reset after each recession. Instead, debt accumulates layer upon layer. Governments borrow to fund programs and deficits. Corporations issue bonds to finance growth and buybacks. Consumers rely on mortgages, credit cards, and auto loans to sustain lifestyles. Each short-term cycle adds more debt to the system. And because interest rates often trend downward over long periods,
The cost of servicing that debt appears manageable. This creates a dangerous illusion. Lower rates encourage even more borrowing, which pushes asset prices higher, which increases collateral values, which enables still more borrowing. For years, sometimes decades, this expansion feels normal, but eventually debt grows faster than income. At that point, the machine begins to strain. Let me ask you something. What happens when a system built on expanding credit can no longer expand without destabilizing itself? We are now at a stage where total U.S. debt exceeds $90 trillion, combining government, corporate, and household obligations. Government debt alone stands above 125% of GDP. The federal government spends over $1 trillion annually just paying interest on existing debt, more than it spends on defense, education, or infrastructure. That single statistic should provoke reflection. When servicing past obligations consumes more resources than investing in future growth, is the machine strengthening or cannibalizing itself? When interest expenses rise faster than tax revenues, policymakers face constrained choices. They can raise taxes, cut spending, default, restructure, or inflate. Historically, the politically palatable path has rarely been austerity or outright default. More often, it has been inflation, the gradual erosion of debt through currency debasement. Inflation is not always an explosive event like the hyperinflation of Weimar Germany. Sometimes it is subtle and persistent, reducing purchasing power slowly enough that it feels tolerable until the cumulative effect becomes undeniable. During late-stage debt cycles, central banks often inject liquidity into financial systems under names like quantitative easing or stimulus. These policies stabilize markets in the short term, but they expand the monetary base. If productivity does not keep pace, the result is diluted currency value. The saver who believed they were preserving wealth discovers that nominal balances do not equal real purchasing power. So here's the question. If your assets are denominated in a currency that is being systematically expanded, are you truly preserving wealth or merely holding numbers that look stable on a screen? Consider the parallels with history. In the 1930s and 1940s, excessive leverage from the 1920s culminated in collapse, restructuring, and massive policy shifts. In the 1970s, inflation eroded bondholders' real returns for over a decade. In both periods, those who understood the stage of the long-term cycle positioned differently from those relying solely on short-term patterns. Most investors focus on quarterly earnings, election outcomes, or interest rate decisions. Few step back to ask where we stand in a generational debt arc. Yet that broader context determines whether conventional allocations thrive or struggle. If short-term waves are like waves on the ocean's surface, the long-term cycle is the tide. And if the tide is receding, swimming skill alone may not keep you afloat. The machine analogy also clarifies something critical. Policy tools lose effectiveness near the end of long-term cycles. Early in the cycle, lowering rates stimulates borrowing because debt levels are manageable. Late in the cycle, lowering rates has diminishing impact because borrowers are already saturated. Governments can attempt fiscal expansion, but that increases deficits, adding further strain. Central banks can monetize debt, but that risks inflation. Each lever pulled produces side effects. So ask yourself, if policymakers are constrained and debt ratios are historically elevated, how resilient is the system to external shocks? What happens if geopolitical tension, supply chain disruption, or financial contagion intersects with already stretched balance sheets? The machine doesn't break overnight. It strains, adjusts, compensates, and continues running until it can't. And when it reaches that threshold, the adjustment is often swift. Asset correlations shift, safe assumptions dissolve, strategies that worked reliably for decades falter simultaneously. Investors accustomed to smooth recoveries confront structural recalibration. The challenge is that by the time the strain is visible to everyone, repositioning becomes reactive. Prices adjust before narratives change. Understanding this framework does not require panic. It requires awareness. It invites a different kind of question. Instead of asking whether markets will rise next quarter, perhaps we should ask whether current valuations reflect sustainable productivity growth or leverage-fueled expansion. Instead of assuming bonds always stabilize portfolios, perhaps we should consider how inflation interacts with fixed income instruments in late-cycle environments. Instead of relying exclusively on past averages, perhaps we should examine structural debt dynamics. The economic machine is elegant in its predictability, yet ruthless in its corrections. Productivity drives genuine wealth. Short-term cycles create manageable expansions and contractions. Long-term cycles accumulate imbalances until adjustment becomes unavoidable. And if we are indeed late in such a cycle, the critical question is not whether volatility will occur, but whether portfolios are structured to endure it. So, as you look at your own financial positioning, ask yourself this: are you investing for the environment of the last 30 years or preparing for the environment that historically follows decades of compounding debt?
When a long-term debt cycle reaches its final stage, policymakers are confronted with three options, and none of them are painless. The first is default, the second is restructuring, and the third is inflation. And history shows that when forced to choose, governments almost always lean toward the path that appears least dramatic in the short term, even if it quietly erodes wealth over time. Let's examine these choices carefully because understanding them may change how you view your own portfolio. Default is the most straightforward and the most politically explosive. It means debts are simply not paid. Governments refuse or are unable to honor obligations. Corporations declare bankruptcy. Financial institutions collapse. On paper, this wipes the slate clean. In reality, it detonates confidence. Banks fail, savings evaporate, credit markets freeze. In modern developed economies, outright sovereign default is rare, not because it is impossible, but because it is socially destabilizing. Leaders avoid it unless absolutely cornered. The second option is restructuring, extending maturities, reducing principal, renegotiating terms. This is default by another name, only slower and less visible. If you lent $100 and are told you will receive $50 over 20 years instead, you have lost half your purchasing power, even if the process is framed as cooperative. Now consider the third option, inflation. Instead of refusing to pay, governments print or expand currency until the real value of what they owe shrinks. The debt is technically repaid, but in dollars worth far less than when they were borrowed. If you owed $100,000 and inflation halves the purchasing power of the currency, you effectively repay that debt with money worth $50,000 in real terms. For debtors, this is relief. For savers, it is silent confiscation. So ask yourself, if you hold large amounts of cash or long-term fixed income assets, what happens when inflation becomes the chosen path? Throughout history, inflation has been the preferred escape valve because it distributes pain subtly. It does not announce itself as a crisis, it creeps. Prices rise gradually, wages lag, savings accounts lose purchasing power quietly. Central banks rarely describe their actions as currency debasement. They use terms like liquidity provision, quantitative easing, monetary accommodation, or stimulus. These words sound technical, even reassuring, but beneath the language lies a simple mechanism: increasing the money supply faster than the production of goods and services. When more currency chases the same output, purchasing power declines. Consider the 1970s. Inflation in the United States averaged between 7 and 9% for years. Bonds, traditionally viewed as safe, lost more than half their real value over the decade. Savers who believed they were preserving wealth discovered that nominal returns did not equal real security. Could something similar unfold again if debt burdens continue expanding? Or are we confident that modern policymakers have transcended historical patterns? The dilemma intensifies because inflation can initially feel like growth. Asset prices rise, nominal GDP increases,
Tax revenues expand. Governments appear more solvent in nominal terms, but this is often illusionary. If living costs rise faster than wages, households feel squeezed. If interest rates rise to combat inflation, debt servicing costs increase, compounding fiscal strain. Policymakers then face a paradox: raise rates aggressively and risk recession and financial instability, or keep rates low and allow inflation to erode purchasing power. Which choice do you think elected officials are more inclined to make when facing political pressure? Historically, they attempt to balance both, often tightening briefly before reverting to accommodation. The result is prolonged periods where real returns on conservative assets remain suppressed. Imagine you are a retiree living on fixed income. Your portfolio holds long-term bonds yielding 3%. Inflation runs at 6%. Each year, your purchasing power declines by 3% in real terms. Over a decade, that erosion compounds significantly. You may not feel the loss immediately, but gradually lifestyle adjustments become necessary. This is the hidden tax of inflation. It does not require legislation. It does not pass through Congress. It operates automatically once currency expansion outpaces productivity. So the question becomes, are you positioned as a debtor who benefits from inflation, or as a saver whose wealth depends on stable purchasing power? The scale of modern debt magnifies this dynamic. With total obligations exceeding $90 trillion in the United States alone, servicing costs strain budgets even before economic downturns. If growth slows while interest expenses remain elevated, fiscal flexibility narrows. Under such conditions, inflation becomes not merely a convenience, but a temptation. It reduces real debt burdens without explicit default. Yet inflation also distorts capital allocation, misprices risk, and amplifies inequality between asset holders and wage earners. Could prolonged inflation alter social stability? Could it reshape political landscapes? These are not abstract concerns. They have accompanied many historical debt resets. Some argue that technological progress will offset inflationary pressures. Others contend that globalization suppresses price growth. Perhaps, but supply chains can fragment. Geopolitical tensions can disrupt trade. Demographic shifts can alter labor markets. If inflation emerges amid high debt, policy responses become constrained. And remember, inflation is not purely monetary, it is psychological. Once expectations shift, once businesses and consumers anticipate higher prices, they behave accordingly, accelerating the cycle. Have you considered how quickly confidence in a currency can erode once doubt spreads? The critical insight is that inflation does not destroy all assets equally. It redistributes wealth. Borrowers with fixed-rate obligations benefit as real repayment burdens shrink. Owners of scarce, tangible assets may see values rise. Holders of fixed-income instruments suffer unless yields adjust upward sufficiently, which can in turn depress asset prices. Cash, once considered king, becomes vulnerable if not earning returns exceeding inflation. Therefore, understanding the likely policy path at the end of a debt cycle is not about predicting apocalypse, it is about recognizing incentives. Governments facing unsustainable debt rarely choose visible pain over subtle erosion. So let me ask you directly, if inflation becomes the dominant resolution mechanism for excessive debt, is your portfolio designed to preserve purchasing power or merely nominal balance? If policymakers choose gradual debasement over abrupt default, would you even recognize the shift until years of compounding have diminished your real wealth? And perhaps most importantly, are you relying on past decades of low inflation as proof of permanence, or acknowledging that monetary regimes evolve when debt burdens demand it? Understanding these three choices, default, restructuring, or inflation, is not academic theory. It is a lens through which to evaluate risk in a late-stage cycle. The system will adjust. The only question is whether you adjust before it does. When debt cycles unwind and currencies are pressured, the destruction rarely falls evenly. Some assets are crushed, while others quietly endure. and understanding this difference can mean the line between preservation and permanent loss. History suggests that when paper claims weaken, when bonds lose real value, when over-leveraged equities collapse, when speculative assets implode, capital does not disappear, it migrates. It searches for safety, scarcity, and durability. In the 1930s, as banks failed and stock markets plunged nearly 90% from peak to trough, those who held purely financial claims suffered devastating losses, yet those who owned tangible, productive assets often weathered the storm more effectively. During the inflationary spiral of the 1970s, traditional bondholders saw their purchasing power deteriorate year after year, while holders of gold, energy resources, and productive land experienced dramatic gains in nominal and often real terms. This is not coincidence. It reflects a structural shift in what the market values when confidence in currency weakens. So ask yourself, if paper promises become less trustworthy, where does capital seek refuge? Physical stores of value, such as precious metals, have historically functioned as monetary insurance, not because they generate cash flow, but because they are scarce, cannot be printed, and have maintained purchasing power across centuries of regime change. Gold does not depend on a government's balance sheet. It does not rely on corporate earnings projections. Its value rises when trust in paper systems falls. In times of monetary expansion, gold often acts as a mirror, reflecting the erosion of currency. Consider what happened between 1971 and 1980 after the U.S. abandoned the gold standard. Gold rose from $35 an ounce to over $800, not because it suddenly became more productive, but because the dollar's purchasing power declined. Could a similar repricing occur if debt expansion accelerates once again? And if it does, will it be obvious at first, or will it begin quietly, gradually, almost imperceptibly? But survival assets are not limited to metals. Businesses with genuine pricing power, companies that can raise prices without losing customers, have historically endured inflationary environments more effectively than broad indexes. Think of consumer staples companies whose products remain essential regardless of economic conditions. During periods of rising costs, these firms can pass increases to consumers, protecting margins and preserving real value. In contrast, growth companies dependent on cheap financing and optimistic future projections often struggle when interest rates rise and capital tightens. Which type of enterprise dominates your portfolio today? The one dependent on abundant liquidity or the one resilient under constraint? Short-term government securities and liquidity also play a paradoxical but critical role during crisis phases. While long-term bonds suffer from rising yields and inflation risk, short-duration instruments limit exposure to interest rate volatility and preserve flexibility. In every major downturn, from 2008 to 2020, those with liquidity were positioned not only to survive, but to acquire distressed assets at significant discounts. Cash, when held strategically and not excessively, becomes optionality. It allows action when others are frozen by fear. Yet holding too much cash in an inflationary environment erodes purchasing power. The balance is delicate. Do you view liquidity as dead weight or as strategic ammunition? Then there are productive real assets, farmland, energy infrastructure, rental properties, assets that generate tangible output regardless of financial market volatility. People need food, shelter, and energy, whether markets are booming or collapsing. During historical resets, these assets often maintained intrinsic value because they are rooted in physical necessity. In contrast, purely speculative assets dependent on sentiment evaporated when confidence faltered. If a currency weakens, land still produces crops. If markets freeze, rental properties still generate rent. The difference lies in tangible productivity versus paper valuation. So consider this. Are your holdings anchored in real-world utility or primarily in market optimism? What ties these survival assets together is not magic, it is structural resilience. They either cannot be easily diluted or they generate essential value independent of financial engineering. They thrive not because crises are desirable, but because they are positioned for durability, and durability becomes priceless when volatility intensifies. The window before a systemic adjustment is often subtle. Asset prices may still be elevated, confidence may appear strong, but underneath, imbalances grow. Those who reposition early often appear overly cautious until they are vindicated. Those who wait for confirmation frequently act only after losses have already compounded. So here is the uncomfortable question. If markets experienced a prolonged period of inflation, rising rates, and credit contraction simultaneously, which of your assets would likely maintain purchasing power? Which would depend on a continuation of easy money? And if a reset unfolded faster than expected, would you have liquidity to respond, or would you be forced to sell into weakness? The assets that survive are not necessarily the most exciting during expansion phases, but they become anchors when cycles turn. The challenge is psychological. Can you allocate toward resilience before panic makes it obvious? Because by the time safety is universally recognized, it is often too late to acquire it at a reasonable price.